Welcome back to our channel. Thank you so much for tuning in. The International Monetary Fund, IMF, has updated its economic growth outlook for two countries. And guess what? Neither of them is a Western nation. According to the IMF, the top three economies in terms of expected growth by the end of this year will be India, China, and Russia. The United States comes in fourth, followed by Saudi Arabia, rounding out the top five. Unfortunately, the UK and the European Union lag significantly behind, along with Brazil, South Africa, and Japan. This isn't great news for those of us in Europe or the United States. The Eurozone is expected to grow at a modest rate of 0.8%, while China is forecasted to enjoy a 5% growth rate, India a 6.8% growth rate, and Russia 3.2%. These are quite surprising projections, all issued by the IMF. Now, let me ask you this. What do these top three countries have in common? Interestingly, all three are members of the BRICS bloc. The IMF further explained that the baseline forecast for the world economy is to continue growing at a 3.2% rate during 2024, maintaining the same pace as in 2023. However, the forecast for global growth 5 years from now is just 3.1%, the lowest in decades. The IMF is also forecasting a decline in inflation, though this could be part of their standard optimistic projections. What's particularly telling is the 5-year ahead real GDP growth projection, which extends through 2029. From this year onward, there is a sharp decline in real GDP, a downturn not seen in over 2 decades. If the best-case scenario projects real GDP growth hovering just above 3%, consider what the worst-case scenario might be. This best-case scenario assumes no major shocks to the supply chain or labor force availability, among other factors. Given the current level of tensions in the Middle East and other global hotspots, the worst-case scenario is certainly a possibility worth considering. Reflecting on the growth projections I mentioned earlier, it's quite surprising that despite China's economy being nearly 5 times larger than India's, the IMF believes India's growth will outpace that of China. Briefly, I want to note that not everyone agrees with this data or conclusion, and many of you might have different opinions. I encourage you to share your thoughts in the comments below. I would love to hear from you. For instance, Eric Li, a political scientist and businessman from China, is one of the skeptics. In a recent interview, he pointed out that China, in just 3 months, a single calendar quarter, increased its industrial capacity to match not just the combined capacity of the United States, Japan, and Germany, but also added the equivalent of India's total industrial capacity. This suggests a significant leap in China's industrial growth, according to Li. Check out this portion of his interview and let me know in the comments what you think. Do you agree with the IMF's projections? Or do you side with Eric Li's perspective on China's rapid industrial growth? I'm eager to hear your views.
Our industrial capacity is China's biggest asset. China's industrial capacity is about 35% of the world's. Okay, we're bigger than US, Japan, Germany put together. I used to say that, and then last month my research assistant said that the numbers have improved actually in the last 3 months, that China's industrial capacity is now bigger than a combination of US, Japan, Germany, and India.
China and India share a unique and complex relationship. While they strengthen their economic ties, they continue to grow further apart geopolitically. Given that the IMF projects their economies to grow at the fastest pace in the world, let's take a closer look at their economic ties. Despite significant political differences and territorial disputes that have occasionally turned violent, China has become India's largest trading partner. Bilateral trade between the two countries has reached nearly $119 billion. This surpasses India's trade with the United States, largely due to imports from China totaling more than $100 billion. For instance, China exports mostly electronics and high-value finished goods to India, while India sells natural resources like iron ore, sulfur, granite, and refined petroleum to China. Both countries support the effort to de-dollarize, with China being more proactive than India. Consider the billions of dollars in trade transacted in yuan and rupees and its potential impact on the US dollar. Additionally, As geographical neighbors, it's convenient for them to increase two-way trade. This trade is likely to grow if they can overcome major diplomatic challenges, such as their border disputes, which would require diplomatic settlements. However, tensions are high, and resolution seems unlikely in the near term. Regardless, trade between China and India has soared, contributing to their economic growth. There is already a degree of mutual dependency on the core goods mentioned earlier, a dependency unlikely to change soon. As countries worldwide transition to sustainable energy resources, the demand for raw materials and rare earth minerals will increase, driving up costs. For India, replacing critical defense technology and other materials from China with affordable alternatives from Western sources would be challenging. Thus, despite political motivations, India's trade policy is unlikely to shift dramatically. I hope you found this quick video interesting. The China-India relationship is not something I've covered in detail before, but if you're interested in learning more, let me know. Like, subscribe, and share. Enjoy the rest of your day, and I'll see you next time. Thank you for watching.